Yeah, hello trader. Welcome to another lecture on chart pattern under our technical analysis um, topic. In the previous class, we already talked about the triple top and the triple bottom, how to take entries, how to place our stop loss, and how to take profits. So now I want us to quickly look at another one that is easy to spot. We call it the head and shoulder pattern. This is very, very, very common. So the head and shoulder pattern. So how do we actually see the head and shoulder, or how does it look like? The head and shoulder pattern is also a reversal pattern. For example, now let's say this market has been bearish. Then we have something like this. So if we look at this now, initially we were bearish, we were selling. This was higher high, then we created a lower high, lower low to this, lower high, lower low. But from here now that we created a lower low, instead of creating a lower high, we created higher high. Then instead of now creating a lower low to continue, so we created higher low. So we now started creating higher high, higher low. So in this kind of situation, we can already see that there has been a change from being from this bearishness now. The market was bearish earlier to bullishness. The market is now bullish. So we've seen this. How do we now enter early after spotting this kind of pattern? Now, why do we call it the head and shoulder pattern? This is why. Now, this is your left shoulder. This is your right shoulder. So in between your two shoulders, as a human being, you have the head. So that is why we call it the head and shoulder pattern. So, and then just like the triple bottom that we did, we also have a neckline. So this particular place now, from here, we can call it our neckline. So it's not always going to be a perfect straight line. It might even happen this way. So that we have it like this. We have it like this. So we can also have it this way. So what are we looking for when we see the head and shoulder pattern? Just like we have different entry model for the triple bottom and triple top. We also have the entry models for this and where to place our stop loss as well. For this now, the conservative model of taking trades from here is number one. You can wait for a breakout of this neckline now. That is this particular form of temporary resistance. Immediately we create a break of this particular neckline now, and you wait for a candle closure, just like in the earlier class. You can actually enter your buy. You know, you enter your buy and take your stop loss. Okay, sorry. You enter your buy from here. Probably we closed here. You enter your buy from here. You place your stop loss at this low, and then you can target the next high. Probably there is a high here that you can target. You can target 1 to 5, or probably if you are the one that target based on pips, 50 pips. So that is the first entry model. The second entry model is going to be waiting for a retest of this. That is after breaking out, after we must have broken out of that place, of that neckline. We broke out here. We wait for the market to do its thing. Then we wait for a retest, and then we enter from the retest. So which means we are going to like place a buy limit here, or if it's not going to be a buy limit, you are going to wait for the market to actually come here itself before you are going to take a buy. So here I place my buy, I'm still going to place my stop loss at this low. Because why am I placing my stop loss at this low? If the market should now decide not to continue buying and sell like this, and we broke this low, it means we have actually, you know, shifted from, this bullishness that we were initially printing. It means this bullishness that we printed was just a fake out. We will still continue our selling. So that is why we have to be sure that where we are placing our stop loss should be by this low to be safe. Because if you kind of place your stop loss, let's say at the midpoint, the market might just clear you out at the midpoint. Or if you say you are placing your stop loss below here, you can actually place it here. But being too tight, having a too tight stop loss can be to your detriment. So it's better to be safe than sorry. So you can place your stop loss here as well if you're looking for, bigger RR, tighter stop loss. So but I would advise use the last low as your stop loss. Then you take and hold high as your take profit, or you target based on number of pips, probably 50 pips, 20 pips, 30 pips, whatever that works for you. So that is just for when we are taking a buy. So at the same time, the market can also present to us the normal head and shoulder pattern. The initial one for the buy is the inverse. So the normal head and shoulder pattern is also going to be like this. Probably we have this now. So this particular point now is going to be our neckline. So what are we waiting for? We are waiting for the market. Initially this was acting as a support for the buys. We touched there, we bought, we touched there, we bought. But immediately we break out of this neckline and we have a candle closure here, I can take my sell. Or better still, I'm going to wait for a retest. After we break here, probably the market was selling. I'll wait for the market to come back here and then enter the sell. Because the reason why, this kind of chart pattern are A patterns, A kind of setup is because whenever we change bias in the market, which are expecting a very long move, at least before we are going to see a major pullback. What do I mean? If we have been bullish initially, the market was buying from here, we were buying, we and then if we got to the point whereby the market now decides to change from this bullishness to bearishness, we expect the market to also sell for long, just like it's bought for probably a very long time. So we expect you can target as much as 100 pips, 120 pips, 150 pips. It just depends. You can also target this last low because you already know that we've changed bias. We've changed from being bullish to being bearish. So let's now go into our chart to see a live example of the things that we have talked about. Now, so if we look at this particular pair, Euro AUD on the 2 hours, we can spot something from here. What can you see? You can see this particular left shoulder, this head, and this particular right shoulder. Then this was the point that this got broken. We can pick this point as our neckline. This was our neckline. Yeah, it doesn't look that clean, but at the same time, this can also be seen as head and shoulder. But let's look for something cleaner that we can work with. Okay, so moving along, I think yes, we can find something clean now. If we look at this now, we have this left shoulder, we have this head, and we have this right shoulder. They are not always going to be equal or perfect, just like the diagram that we were shown. So now, this can be seen as the neckline. We broke through this form of uh, support. We broke through this form of support. This was acting as a form of support. From here we bought again. Now immediately we break through this neckline. Let's treat it as a zone, because like I told us before, we should treat support and resistance like a zone. So immediately we have a break of this. We have been bullish. We're buying. This low created this high, higher low, higher high, higher low, higher high. This, in fact, we still even didn't break this major low. We still went ahead to, kind of create a form of equal high here, relative equal high. So now looking or seeing this particular formation now is indicating to us that probably we are about to start, a sell. You can pick the zone from here, you know, so that we'll be able to be safe if we are placing our stop loss or anything. So now immediately we see a break of this particular zone by this candle. This is a very strong bearish candle that broke this. Now immediately we see a closure below this particular neckline that we have here. Now I can place my short position, my sell, place my sell here, my stop loss at a high or above the right shoulder. Then I'm going to target, probably take a 1 to 5 target, or target this last low that we had here, this low that was here. So then I'll just take my target here, and then I can move my stop loss to around here, which is still safe enough, to take a trade from there. So that is on breakout. Now if you are not taking the trade based on breakout, if we move to lower time frame, this is 2-hour time frame. If we move to lower time frame, I think we are still going to see this zone more clearly. Let's see how we can get something better from there. Okay, this was the one we were looking at. So if we look here, we sold a bit here. This is waiting for the market to sell a bit away from that zone that we broke out from. Then we made a retest. So which means you can actually take an entry with retest from this particular trade, which means after we must have sold, I'm going to place my sell limit here or wait for the market to come here and execute my sell. Then I'll still take my sell in that manner. So those are just the little um, um, hints that we can take from these chart pattern types, looking at them, where to place our stop loss, where to take our profit, and where to enter from. So apart from this head and shoulder now, we can also have an inverse form of it as well, where we are going to probably we are in a bearish phase, and then when we see the inverse formation below, we are going to take a buy from it. So that is another pattern that we should be looking out for. So apart from the head and shoulder, the triple bottom, triple top, we can also look for double top and double bottom. They are also chart patterns that are very common to see. If you look at this here now, it's the same pattern with the triple bottom and triple top. The only difference is that we only have 2 bottoms here instead of 3. So this is our neckline. We have our neckline around here. And I said we should treat the neckline as a zone so that to be better, clearer. So now here immediately this leg now broke through, or we have a candle closure. We don't have a candle closure here. So this was the place where the candle actually closed above. So which means immediately I witness or I see a candle closure, we can place our entry here, our stop loss. We can use this old low, or we can even use the bottom, the second bottom, and then we can target the next high, this particular high. You can see the market went up a lot. not even a bit. So we can target like 1 to 2 RR, 1 to 5 RR, depending on our stop loss. So I can make my stop loss to be tighter and target this particular um, candle here. So as my stop loss, then I can see you can take actually make 1 to 4 or 1 to 3 from this particular trade. So you can actually take the entry, or you can actually wait for a breakout as well. This was the breakout, and then we wait for the market to retest. Now, how am I going to get into the retest? I already know that this was formerly a resistance that has now turned to support. And that was why I said we should treat this as zones. If I treated it as zone now, which means I'll be able to get into this trade. Let's say the zone was just as much as this, covering this eye here. So we can be able to take another entry or buy from here. Probably you missed entry from here. You can take another entry from here. In fact, this one will even give you more RR. Just target this low here because it looks protected. Then you can make this eye your next target. Make this eye your next target, and that is just a quick 1 to 3 RR trade. So that is for a double bottom. So the inverse is for the double top. That is, for that you are going to be selling. It means it is just a bearish signal. This is a bullish signal. So understanding all these chart pattern, you need to know when to use them, where to take entry from, where to exit from, either through your stop loss and your take profit. So, and you must make sure that you are using them in confluence with other things that we know. Just like we're looking at the neckline, we're looking at those neckline like a form of zone for resistance or form of zone for support. So just like we understood in our former lectures. So you can as well go through your charts, identify some of these chart patterns, the ascending triangle, we have the bullish flag. These patterns are very common, and you see them very often forming. So if you want to be trading these chart patterns, it is advisable for you not to look at them on the lower time frame, just like it's advisable for you to mark your resistance and support zones on the higher time frame. So mark these chart patterns on the higher time frame because they have high probability of playing out compared to on the lower time frame. So we have other chart patterns like the bullish flag, the bearish flag, and so on and so forth. For the flag, we can have something like this. We were bearish, probably the market is bearish before, majorly bearish, and then you see the market creating this kind of formation, this small bullish formation. It is just a flag for you to, it's a sell chart pattern. It's signaling a sell. And if it is the opposite as well, probably we're buying and you saw like a little sell formation forming. If you are not used to or you don't understand what this chart pattern is telling you, you probably think, okay, we're actually selling. No, you can see that there is no major break of this low. We're just trying to, tell the retail traders to, okay, enter the sell. So, and when they, get into this sell, they are going to be taken out by another buy from the market, which signals that this particular chart pattern now is just a continuation pattern. It's not a reversal pattern like the head and shoulder, the double bottom, or the double top. So you can also always look at your chart. The more you practice identifying some of these patterns, the easier it is for you to get to see them on your chart always. So thank you, and I will see you in the next lecture.